So we've all become a bit numb to this inflation story over the course of the last decade. With the start of quantitative easing back in the days of Ben Bernanke coming out of the Great Recession, the argument for mass rampant inflation, there's too much stimulus, there's got to be inflation, and it really never came to bear. And suddenly it's kind of like the boy who cried wolf, and real inflation is here, and nobody seems to be in a big panic about it because they ultimately just don't believe it. We've all heard that before. But the numbers are real. The numbers are looking like gasoline year to date is up 44%. Milk is up 20%, coffee is up 17%, poultry is nearly 20%, pork is 60%, and all the metals but gold right now are up. And if you look even at things like lithium used in some of our batteries, that's up 91% this year, just year to date. So massive price hikes are coming, and the government is using the term transitory, right? Which is kind of one of those gray words that could mean a lot of different things so that they can always have a way out and say that they were never quite wrong, right? So ultimately, I think right now what we've got is kind of the Spider-Man meme where they're all pointing at each other and nobody wants to take the blame, or they're all blaming some other issue. The reality is it's all kind of coming together to a head. So it is a result of Fed policy with low interest rates. It is a result of massive amounts of stimulus from both the Trump and the Biden presidency. It is a result of COVID. It is a result of all of these massive shortages of materials. You look at the chip makers, you look at lumber, all of these things, there's a shortage of materials, which is sending prices skyrocketing along with wage increases over the last several years as well. So the question ultimately becomes, well, what do I do about it? If you're a saver, it's not necessarily a horrible thing in the long run. There's some volatility that we're going to have to get through. And if you're a spender, this is going to get tough, right? If you're not saving money, if you don't have invested money, this is going to get tough. The things that you use to live your life are going up in price, and probably at a rate that's a lot faster than your wages, even though wages are increasing, right? So it's kind of an additional tax at a time when we've got tax increases. So, for savers, ultimately, that's not the worst thing in the world. What's going to happen is if we see consistent inflation, the Fed will have to step in, and they've already started talking about the need for potential rate increases. A rate increase adds a lot of volatility. Any change adds volatility to the markets overall, but that increase in rates means better things for your savings. It means banks are making more on their loans. It means CD holders, bond holders, etc. suddenly start getting a little bit better yield on their safe money. Does that necessarily, they need to have that because there's been this inflation. But the traditional stores of capital are what has done really well as rates have come down. Things like large cap, big dividend paying stocks have had massive increases in prices. That's going to see some volatility. Long-term bond holdings will see lots of volatility when we have increases of rates and increases in inflation. That doesn't spell a good thing, and the Fed's going to have to get on top of it. Ultimately, and it's going to sound like a cop-out answer, but what people need to be doing is really broadly diversifying their money, rebalancing on a regular basis. You have to get away from trying to gamble and pick and choose these different moments, right? If we've looked at, with all of this inflation coming, you would think with a traditional store of capital to hedge inflation is gold. Well, if you really look, it's not actually that great of a hedge against inflation, and it's about the only metal that's down year to date in value. A lot of folks have talked about Bitcoin. Bitcoin as this store of capital to hedge against inflation. We've seen massive amounts of price volatility over the last couple of weeks especially, but if you look at the last year, it's just a really, really speculative bet to be able to say, well, I'm going to go over here for inflation, and then suddenly we have a 30% price decrease. So the answer isn't great for folks who are looking for where do I go to be safe. The real answer is get as broadly diversified as we can, own small stocks, own value, own international, own the large caps that may see some price volatility. But on our bonds, we should probably be doing short-term, high-quality debt. That's going to see the least price volatility relative to others when we go through interest rate increases. And with that shorter term, I can start getting some new issues into my portfolio a little bit faster that are coming in with higher interest rates. So you need to get with your CPA, you need to get with your financial advisor and start to really work on this. But if you're not saving, that's going to get tough for you. If you are saving, you got to figure out what to do with it, because what we do know is cash is not king in times of inflation. It's one of the worst asset classes, and we're guaranteeing ourselves a loss. So we got to figure out how to grow our money and be able to ride the wave a little bit.